Now speaking, Kristen Rose, Director, Investor Relations. Good morning everyone and thank you for joining our second quarter 2023 combined earnings conference call for NextEra Energy and NextEra Energy Partners. We are pleased to report strong financial results for the quarter, with NextEra Energy delivering adjusted earnings of $2.17 per share and NextEra Energy Partners delivering adjusted earnings of 45 cents per share. Our results were driven by strong performance from our regulated businesses, as well as our competitive businesses. We also achieved a number of important milestones during the quarter, including the completion of the acquisition of Gulf Power and the announcement of a new partnership with Microsoft to develop renewable energy projects. We remain focused on executing our long-term strategy and creating value for our shareholders. Now speaking, Kirk Cruz, Executive Vice President, Chief Financial Officer, NextEra Energy. For the first half of 2023, NextEra Energy reported adjusted earnings of approximately $3.6 billion or $1.78 per share, an increase of approximately 11% year-over-year. We remain confident in our ability to deliver on our expectations for the full year and create long-term value for shareholders. NextEra Energy continued its track record of solid execution as reflected in its second quarter results. Adjusted earnings per share grew by 8.6%, driven by FPL's regulatory capital employed growth of 12.1% year-over-year. FPL's capital investments were approximately $2.5 billion for the quarter and are expected to be between $8.5 billion and $9.5 billion for the full year 2023. FPL's reported ROE for regulatory purposes will be approximately 11.8%. FPL placed into service roughly 225 megawatts of cost-effective solar in the quarter, bringing the total year-to-date solar additions to nearly 1,200 megawatts. Over the current four-year settlement agreement, FPL is expected to make capital investments of between $32 billion to $34 billion, including approximately $10 billion in new solar generation and approximately $14 billion to $16 billion in transmission and distribution infrastructure. Energy Resources had a solid quarter of new renewables and storage origination, adding approximately 1,665 megawatts to the backlog, bringing the total to roughly 20 gigawatts. This includes projects in early-stage diligence in the current backlog and is supported by roughly 145 gigawatts of interconnection queue positions. Energy Resources reported GAAP earnings of approximately $1.462 billion, or 72 cents per share, and adjusted earnings of approximately $781 million or 39 cents per share, an increase in adjusted earnings per share of 4 cents year-over-year. For the first half of 2023, NextEra Energy reported adjusted earnings of approximately $3.6 billion or $1.78 per share, an increase of approximately 11% year-over-year. The company remains confident in its ability to deliver on its expectations for the full year and create long-term value for shareholders. Wolfe Research analyst Steve Fleishman inquired, "What is driving the higher margins in the customer supply trading business?" John Ketchum replied, "Yes, Steve. This quarter, our customer supply and trading business has seen less competition, which has resulted in significant margins. We provide full requirement services to municipalities and cooperatives, helping them manage their power needs and regulatory requirements. These arrangements are typically 2 or 3 years and we immediately hedge the positions. Our competitive advantages, core operations and skill sets match up well with this business. Additionally, we run it at a very low VAR of 2%. John Ketchum replied, "Steve, I want to emphasize that the customer supply and trading business has never contributed more than 10% of NextEra Energy's net income in the past 10 years, including this year. We have a diversified portfolio of businesses, such as FPL and Energy Resources, in addition to our renewable business. This 10% commitment is something we make to the rating agencies and it has been upheld." Wolfe Research analyst Steve Fleishman inquired, "What is the latest information you have heard regarding the timing and key issues of the hydrogen green rules from the government?" John Ketchum replied, "Yes, we have been vocal about the need for hydrogen regulations. The debate is between hourly and annual matching. With an expensive asset like an electrolyzer, it's easy math. If you can use it around the clock, the price of green hydrogen will be lower. We've proposed that hourly matching not kick in until 2028, with annual matching until then, and additionality for annual matching. This sends the right price signal to OEMs to ramp up production on electrolyzers, which will lead to declines in green hydrogen prices. We expect Treasury to come out with regulations soon, likely in September or October. Our hydrogen pipeline is over $20 billion and 250 gigawatts, and can be used for dual purpose. We feel well positioned and expect hydrogen investments to contribute to our development expectations in the latter part of the decade." Wolfe Research analyst Steve Fleishman inquired, "When do you expect to announce the Texas sale and how should we consider recent data points such as the TransCanada, Columbia, and Cove Point sell downs in terms of Net's valuation?" John Ketchum replied, "Yes, thank you Steve. In terms of timing, we anticipate being in a position to support our end-of-year sales timeline by the end of the third quarter or early fourth quarter. Valuation-wise, these assets are unique. As a reminder, the Texas pipelines provide 25% of the natural gas supply to Mexico through contracts with Pemex, and the other pipeline assets that support the Texas pipeline are fully integrated with it, providing gas to Mexico's Agua Dulce, a very liquid trading point. These assets are strategic for many players. It's hard to compare one pipe to another, but we remain pleased with the progress we're making on the sales transaction. To clarify, the VAR is $2 million for PMI. Guggenheim Partners analyst Shar Pereza inquired, what opportunities exist to leverage your platform and acquire existing assets or developer books, given the tight financing and supply chain position of competitors? John Ketchum replied, yes, we are actively looking at M&A opportunities. Our portfolio of high-quality renewable assets, built over the last 20 years, is well-positioned compared to other developers. We have a cost of capital advantage, a team that understands how to optimize existing assets, and the largest fleet in North America with existing interconnection agreements. This gives us an edge when it comes to repowering assets and pairing them with storage to take advantage of the standalone storage ITC. We are seeing capacity values and reliability being priced higher than in the past in certain markets, which coincides with our wind assets. All of this allows us to bring value to M&A opportunities. Guggenheim Partners analyst Shar Pereza inquired, John, what is the current status of the FTC case and have there been any changes or opportunities to settle? John Ketchum replied, yes, thank you Shar for the question. We anticipate hearing back from the SEC regarding their reasonable belief to investigate sometime in the first quarter of 2024, based on historical precedent. Bank of America Merrill Lynch analyst Julien Dumoulin-Smith inquired, what impact has IRS clarity had on the ability to close contracts and commit to backlog additions in the near term versus the later years? John Ketchum replied, good question, Julien. We're in great shape for 23 and 24, and we've already added 12 gigawatts in the last 6 quarters, putting us on track to reach our midpoint of 15 gigawatts by 26. Supply chain issues and circumvention caused delays and shortages in 22, but those projects are now coming online. This is good news for customers, as they can now access the market again. Prices are also coming down due to a relaxation of risk premiums and increased U.S. supply. Transferability is in accordance with GAAP and flows through the tax line for tax credits. Overall, we feel very optimistic about the future of renewables. Bank of America Merrill Lynch analyst Julien Dumoulin-Smith inquired, John, how do you feel about the acceleration of contracting in the back half of the quarter? John Ketchum replied, yes, the 22 projects coming online in 2023 and customers returning to market will be key factors in our success this year. We are optimistic about the rest of the year's outlook. John Ketchum replied, Julien, hydrogen is a key component of our renewable energy strategy. We are confident that with the right regulations in place, we can add a third customer class to our renewables portfolio, customers who use renewables for hydrogen production. This is an exciting opportunity for us and we look forward to exploring it further. Bank of America Merrill Lynch analyst Julien Dumoulin-Smith inquired, what impact will the new rules have on the third customer class in the next quarter or two? John Ketchum replied, yes, that's correct. The projects have longer lead times, so investors should expect the contribution to come in the latter part of the decade. Morgan Stanley analyst David Arcaro inquired, could you provide an update on alternative financing approaches to reach NEP's longer-term growth projections? John Ketchum replied, yes, our simplification strategy, which we shared with the market in May, is focused on reducing our equity requirements in 2024. We have a lot of flexibility under our current metrics with the agencies to add additional debt-based capital market financing mechanisms to accommodate growth beyond 2024. We are actively looking at the back-end 3 suppers and ideas to address them. There is a strong bid for renewable assets long-term, and we are engaging in discussions to capitalize on our 20-gigawatt backlog, growth visibility, and competitive advantages. Morgan Stanley analyst David Arcaro inquired, what visibility do you have into hitting longer-term growth targets with the 145-gigawatt interconnection queue? John Ketchum replied, yes, we have secured interconnection capacity for 145 gigawatts of our 250-gigawatt pipeline. This is a significant number compared to our competitors and demonstrates our focus on early-stage development. Additionally, we are taking transmission and interconnect issues into our own hands through NextEra Energy Transmission and Grid Alliance. We have already announced a $400 million project in CalISO and are evaluating other transmission projects. Our goal is to solve these problems ourselves as we go along. Goldman Sachs analyst Carly Davenport inquired, what is the rate of change in the supply chain for wind and solar projects compared to recent quarters? John Ketchum replied, in terms of wind projects, we primarily work with GE and have done a bit with Siemens. We don't have any Siemens Gamesa service in our fleet. Wind turbines are made almost exclusively in the US, so there will be direct beneficiaries of the manufacturing incentives and domestic content. There are still some paperwork issues to work out with Treasury, but they are continuing to work through them. Solar issues that plagued the industry in 22 have been addressed in 23, and now we're seeing more capacity show up in the US and other markets. We are taking advantage of these opportunities and leveraging our buying power. Goldman Sachs analyst Carly Davenport inquired, "Can you discuss how you are managing costs in this challenging environment and what levers are available to maintain high earnings?" John Ketchum replied, "Yes, Carly. We have a cost savings initiative every year at the company, which we call Velocity. It's a bottoms-up process that challenges our business units to come up with cost savings ideas. Over the last 10 years, we've identified over $700 million in cost savings initiatives. We're leveraging technology, such as AI, to further reduce costs. We're also focused on buying equipment, building, operating and financing more efficiently to gain a competitive advantage. All of these efforts will help us maintain our market share and progress our renewable development program."